It's good to see you again, Sebastien. Why do you say that you are bullish on the economy but not as much on stocks?
Yeah, you need to reconcile those views. It's hard not to be bullish on the economy. We have had 1.6 trillion in excess savings in 2020. That is 22 years of excess savings. A lot of it has yet to be unleashed into the economy. So I believe in the pent-up demand story. And in fact, we've just sent 130 million checks of $1,400 or more. So we are dropping money from the helicopter into the economy. And meanwhile, look, close to half the population's had one dose of the vaccine at least. So really hard not to be bullish on the economy. The problem, Sarah, is everybody else is bullish on the economy. And stocks, they're up today. They're up 90% since the bottom. The price earnings ratio is in its 99th percentile of its long history. And even relative to yields, stocks are starting to look a bit expensive, 85th percentile. So I'm not saying stocks are in a bubble. I'm saying cautious on stocks. We're pulling back. We've taken about 1% of our exposure away from our strategic targets and put the proceeds in dry powder, cash, loans, short-term tips. So we're positioned to take advantage of opportunities through the volatility of over the next few months. But that's how you reconcile it. Meanwhile, you can still take advantage of relative valuation opportunities. The way I think about it is you can get cheap exposure to the recovery by being long value relative to growth, long small relative to large cap, and in fixed income by being short duration, because even though rates are down today and growth stocks are up a little bit, the direction of travel for rates is likely to be upwards over the next few months.
See, I thought you were going to make an argument for inflation concerns, higher interest rates, higher yields, and tie that to the valuation concern. But it doesn't sound like you're saying that. You're just looking at sort of sentiment, positioning, those sort of things.
Sentiment and positioning are extended, and they have not been for most of the rally, and we've been long stocks for most of the rally. But Sarah, inflation is the number one risk that is keeping asset allocators up at night. So we're not ignoring it, and we're seeing a spike in inflation. And the big debate is it transitory, or are we entering a new regime? A lot of people have called for new inflation regimes over the last decade and have been wrong. But we are in an unusual situation. We're at peak base effects. My view is that inflation will settle back down, but higher than the base level we had prior to the pandemic. But let's not underestimate the base effects. Autos up 10%, used cars up 10% in April. Hotel rooms, airline tickets up 10% in 1 month. Gasoline, if you look at headline inflation, up 45, 50% year over year. So we're really hitting the sweet spot of the base effects. And as you were just talking about earlier, the market's not necessarily buying it. It's kind of like, is that all you got, inflation? So I do think you need to look at labor costs, and there are real pressures there, and things like rent, if you want to understand the new normal, if you will, for inflation, which in my mind is not a risk to stocks in isolation, except if it forces the Fed's hand. But if you think about it, we could run 3% year over year for the next 3.5 years, and we'd still just averaged 2% core PCE over 10 years. And remember, the Fed has said we're going to target average. So to me, we settle back at a higher level, but it's not a huge risk for stocks.
Shepard Smith here. Thanks for watching CNBC on YouTube.